Melody Wright on the channel yesterday. What did she have to say? We can talk about WeWork, DR Horton. We can talk about 3 different Fed presidents. And of course, we got to talk about Wednesday, November 8th. I hope you're having an amazing day. Let's get into the headlines first. Let's talk about Melody Wright and our conversation yesterday. First and foremost, if you don't know who Melody Wright is, you need to give her a follow. She has deep experience in the mortgage industry. She was hands-on in the Great Recession. I respect Melody Wright. I respect her insights into what is happening into the mortgage, aka debt markets. I also think it is fair to say that Melody Wright and I have different opinions about the housing market. That is important. You can't live in an echo chamber where everyone agrees with you. Also, you can't engage, or at least I won't engage, with people who are just doomers, fearmongers, and have no experience. This is what makes Melody Wright different, in my opinion. She's been there. She's seen some stuff. I respect what she is looking at. So in yesterday's conversation, we dug in to one of her beliefs that I need to know more about. Melody Wright, again, in mortgage, she was part of the servicer. She was doing workouts. She was in the mix. She is highlighting a couple of things that I think are important. First and foremost, we are seeing 30-day delinquencies rise. As she shared yesterday, we are finally seeing 90-day delinquencies rise. So there is some stress in the system. She has also identified a couple of, I don't know, I'll call them truisms, but I'm not sure how important they are. One truism. Apparently, today, when people went through the forbearance and they had a $36,000 back pay, they would stick it on the back of the loan. It was called a workout. Apparently, today, that $36,000 is not showing up as debt. Why is that important? Well, something I have reported several times, the consumer's balance sheet is strongest ever. So, if there's a bunch of debt that's not showing up, maybe the balance sheet doesn't look as good. I believe what she has identified is true. I have no reason to not believe what she is sharing. The question I ask myself is I don't really care about a balance sheet, so it's fictitious numbers, my opinion. 2, is it meaningful? I don't know that answer, right? According to Black Knight last year, we had 4.1 million people go through forbearance. I don't know, was it like 20% or so got a workout? So that's 800,000 people. Of those 800,000 people, how many really got a sec? I don't know. You can really, at least I can really go through gymnastics where the impact is, it's a nothing. Second, we had some talk around the debt not being calculated in debt service and things of that nature. I may be wrong, but it appears a lot of that debt is no payments, right? It just sits there until you sell your house or refi your house, all of that. There's not an extra payment. Then we got into the meat of the conversation. I don't think I'm misspeaking, but Melody Wright thinks we have a credit event on the horizon. I tend to agree. Where I think the discrepancy is, again, I hope I'm not saying things that she doesn't agree with, but if you watch the video, you can tell me. I believe Melody thinks the pain is coming to housing, right? She's talked about fraud, DSCR loans, all of these things. It feels to me that she is leaning towards housing being the culprit a la 2008 all over again. Again, as I've started to share the last couple of months, I believe that is unlikely. I believe mom and dad, and again, this is about households. I believe households who are looking at their mortgage payment, we have an effective mortgage rate of 3.6%. We've had crazy rent inflation. We have the demand for housing going up. I believe most households, not all, most households will choose to do something else than lose their house. We are going to see the 10-year and single-family homes go up from an average of 8 years to something like 12 or 13 as people simply don't move. But what does that mean? Michael, you see a credit event, you don't think it's housing, where is it? Well, I think it's in credit cards and I think it's in autos. I think there are a lot of people who got, stimulus ballers who went out and got $1,000 payments on cars. They're going to let them go and they're going to get a cheap and terrible $5,000 car. I believe people are going to call up their credit cards and say, hey, I'm out, stop paying. I think they are going to fight to stay in their home. That is where we are at right now, is what does the American household do? And then lastly, let's not forget that if it is housing, we are years away from seeing any real impact in foreclosures or short sales. Folks, foreclosure and short sale process in many states was over 1,000 days before forbearance became a thing. So again, I appreciate Melody Wright coming on. I appreciate her sharing her knowledge. She is a gift. She does do research that I don't have access to, so I watch her stuff. Again, full disclosure, she and I don't agree on everything, but I value her opinion and I look forward to seeing what she shares because I will be watching 30-day, 60-day, 90-day delinquencies. And I actually have some more data on that in a minute. Let me see if I can find it in my notes real quick. Here we go. This is what I found after my conversation with Melody. Today, mortgage delinquencies of, I believe these were 30 and 90-day delinquencies, currently are 3.37%. That is the lowest number since 1979. That's according to Mortgage Bankers Association. Okay, so delinquencies are rising, no question. The trend is up. We've come off forbearance. Delinquencies are rising, but they are still clearly historically low. But what about autos and credit cards? Great question. I'm glad you asked. Auto delinquencies, 7.28%, highest since the global financial crisis. All right, how about credit cards? 7.2%, highest since the global financial crisis. Folks, it is my belief that there is a lot of pain in the consumer. And remember, autos and credit cards also impact renters, right? When you talk about home ownership, that is roughly 68, 67% of the public, but auto loans, credit cards is a much larger number. And renters are taking it on the teeth. This is why I think it's autos and credit cards. Because if you are a renter, you have been subject to crazy rent increases. You are being hit with gas and all of these other things while your incomes aren't going up. But if you're a homeowner, you likely have a 3.6% effective interest rate and your payments aren't rising. Yes, insurance. Yes, taxes. But ask yourself, would you rather be a homeowner with a 3% 30-year fixed rate mortgage or a tenant, a renter who gets rent increases every year? This is why I think the stimulus ballers who bought new cars they couldn't afford and have credit card debt that they can't afford, that is why I think the credit event is in autos and credit cards, not housing. So there you go. Fed president, boy, not a lot of economic data this week, but there is a lot of Fed chatter. I actually think Jerome Powell is speaking today and tomorrow. must watch TV, I guess, or actually I should say must read, because I'll read after. I'm not going to watch Jerome Powell. So what did presidents say yesterday? Fed presidents. Neil Kashkari. The housing market is broken. Thank you, Neil. You watch my channel? I kid, of course. But Neil Kashkari is blaming builders, not blaming the Fed. I don't know. The Fed feels like most of us and, not taking ownership or blame. I'll ask you guys, who do you blame? Do you blame builders for not building, or do you blame the Fed for keeping rates too low for too long, allowing all the refis and purchases and 3.6% effective interest rate? Who do you blame for the broken housing market? Do you blame builders or the Fed? Leave comments below. I'm going to guess we got 90% Fed, 10% builders, but let's see what you all have to say below. Number 2, Michelle Bowman. Folks, we have found the hawk. Michelle Bowman, Fed president, says, I believe rates need to go higher to beat inflation. That'll send some chills up your back. How about Christopher Waller? The jump in the 10-year was an earthquake for the market. So they are watching what is going on in the bond market. And the bonds, I think, are down a little bit today. They were down quite a bit yesterday. Of course, talking about the 10-year. How about WeWork? Remember, folks, WeWork went bankrupt. This is not a liquidation. This is a reorganization. The reason WeWork went bankrupt, in my opinion, is essentially they tried to renegotiate leases and they got told no. So WeWork's like, great, we'll go BK and we will start breaking leases immediately. Here's the deal. 24 hours after going bankrupt, excuse me, WeWork has already canceled 70 leases. This is the power of bankruptcy and reorganization. WeWork canceled 70 leases. 35 or half were in New York. Of the 70, 40 locations empty, vacant. And then lastly, of course, because WeWork is now bankrupt, what is going on with their bonds and their debts and all of that stuff? It will be interesting to watch. How about D.R. Horton? D.R. Horton is the largest builder in America. D.R. Horton delivered a beat to the top line, a beat to the bottom line. But remember what I'm telling you. My fear is builders are blowing out inventory now, and they are slowing down. I see a real risk of shelter inflation rising in April, May, and June of next year. So what is D.R. Horton doing? Well, it's not good news. At least in my opinion, it's not good news. What do I mean by that? First, they started 21,100 homes. Means nothing to you, means nothing to me. What does it really mean? That is 8% less than the quarter before. Even the largest builder on the planet is slowing down. All right, how about their inventory? Their inventory is down 9%. This is exactly what I thought was coming. Builders will slow down and they will blow out existing product. Hence, we get to April, May, and June. And if rates are under 7, or even, heaven forbid, 6.5, we have a problem. We just have a problem. So D.R. Horton is doing what I feared. How about mortgage applications? Rates matter, folks. Rates matter. If you don't recall, rates crashed last week. They went from over 8 to below 7.4%. And just like that, mortgage applications are up. Mortgage applications were up 2.5% week on week, and just purchase applications, because 2.5% is purchase and refis, just purchase applications were up 3% week on week. Folks, rates matter. Again, it is my strong belief given my 30 years of studying the consumer, that the consumer is very simple. 8% mortgage rates bad. Pull from the market. They are now in the winter season, the holidays. They're going to stay on the sidelines. They're going to come back to the housing market if they are interested in January and February. And if rates have a 6 on it, 6.9, 6.8, they are going to feel like they got a deal. That's what all buyers want. Everybody buying a home wants to feel like they got a deal. And right now, a 6.8% mortgage rate, when your mind thinks 8, is a deal. And if the builders are slowing down and if nobody is selling a home, what do you think happens next year? It's a scary thought. Joseph Wang could be right. We could have the melt up or crash up scenario in asset prices. Credit card debt, man. Doomers cannot stop talking about credit card debt. Credit card debt is now at another record of $1.08 trillion. Folks, it's a fact. It is a factual statement to say credit card debt is at a record. But I dare ask you to remember the blended interest rate in debt service. If you map out the American household's debt service, we are currently sitting at 9.9%. The high water mark in 2007 and 2008 was 13.2%. What makes the difference? Mortgages. Folks, we got a gift. We had a 2-year gift. We have an ungodly percentage of folks with mortgage rates below 4, so much so that the effective rate is 3.6%. We do not have 51% ARMs. We are not seeing mortgage resets blowing up debt coverage and debt service. Yes, credit card will be a problem. Yes, renters who are getting hit with higher rents and student loans and all of these other things, they will default. But when you look at the massive structure of the U.S. households in general, we are nowhere close to 2007, 2008 pain as far as debt payment goes. So again, lots of stuff going on, but remember, the 30-year mortgage is a gift. Folks, let's congratulate somebody else who got their 8th deal. Peter, congratulations on your 8th deal. Your card will go out in the mail. I'm very happy for you. Folks, if you don't know what this is a card that you can get from One Rental at a Time every time you close a deal. If you get your first deal, I send out a golden ticket, which I don't think I have in my room right now, but you can get one of those as well. And then finally, don't forget the bonus I am giving you. Lots of you need to get a buy box. Lots of you need to be doing the work, building your team, networking, understanding what an average deal is so you can write great offers. I am giving you a November special. If you buy the course, How to Get Started One Rental at a Time, which many of you did yesterday, thank you very much. I will email you back and say, what 2 free bonuses would you like? I suggest the Deep Dive Buy Box, maybe the ORAP Mastermind. There's several $50 courses that you should be looking at. So again, $3.99, get $100 in goodies, and of course, you buy it before the price goes up. So again, How to Get Started One Rental at a Time is helping thousands of folks. You can get in the free Facebook group, interact with thousands of other awesome people. I don't know why you're not there. Buy it now. Start doing the work during the holidays so you are ready to shop next year. And then finally, folks, thank you, thank you, thank you. We are down to 67 seats left. The event on February 17th and 18th will sell out. Trust me, you want to be there. You're going to be interacting and asking questions from 12 millionaires, people who did it different ways. This session on the 17th and 18th is not a pitch fest. Nobody will be selling anything. They will give you a 10-minute intro into who they are, and then people in the audience will line up and ask questions. It's a special event. It's created just for you. It's to celebrate getting to 50,000 and all of us giving back And then we're going to do some special things like do a concert with the broken spectacles. We're going to take a lot of pictures. I got some other stuff in the works. So $199. If you are a couple, I suggest buying 2 tickets so you're in the room. You can get on the same page. You can network with other folks. That's the thing about one rental at a time. We do the work. I am willing to bet you will get amazing information from the speakers, but most of the value you will get is networking with other like-minded individuals. Many of us would benefit from having 2 or 3 folks that think like us, moving in the right direction, and you could do it together. So I hope to see you there. If you're coming, make sure we take a picture, bring your books, I'll autograph them. If you have my second book, 15 Conversations with Real Estate Millionaires, remember, Jason and Jen Pritchard are in that book, and they will be kicking us off as the first speakers. Trust me, you're going to want to hear from Jason and Jen. They got on the same page. They did great things. It wasn't easy. You want to ask them questions. If you're in a relationship and you're not on the same page, you need to listen to Jason and Jen's story, folks. Take care. Have an amazing day. Again, Peter, congratulations. Bye, everyone.